Ethical Perspectives on the News is produced by the Interreligious Council of Lynn County, which is solely responsible for its content. The views and opinions expressed on this program do not necessarily reflect those of the staff and management of KCRG TV9.
Good day, and welcome to Ethical Perspectives on the News. Our topic tonight is corporate flight, and in particular, we're going to look at one way that corporations have taken some part of their business outside of the United States. We have three guests to help us understand this phenomenon of corporate inversion. The first is John Solow. John is a professor of economics at the University of Iowa. He's been at Iowa for 34 years, he tells me.
Years, yeah.
He's the chairman of the department and has a special interest in antitrust law and an interest in economics as applied to sports.
Nice to meet you.
Thank you. We also have with us Veronica Czastkiewicz, who is a political scientist, a candidate for the PhD at Northeastern University in Boston. She is teaching this year at Cornell College, teaching a course on public policy currently. She has worked for the Goldwater Institute, a think tank that looks at public policy questions like this. She's multilingual and has traveled and worked in Europe. And then we also have with us Mark Binsfield, who is a financial advisor with Edward Jones here in Mount Vernon, Iowa. Mark also worked at Rockwell Collins previously as a buyer or purchaser, and he brings the investment perspective to us with the political science and the economics here for us.
Good to be here.
Thank you. Okay, so we have to start by defining this technical term, corporate inversion. And John, you offered to do this, and why don't we start with you here?
Sure, I'll do my best. So corporate inversion is a corporate strategy where typically an American company, a large American company, buys a smaller company located in some other countries, typically somewhere in Europe, and then basically makes that company its headquarters and therefore is subject to the tax law of the company that was acquired. So a big American company might acquire a small Irish company and then say, well, we're now an Irish company and we pay Irish tax. We're subject to Irish tax law, not to American tax law. That's the basic principle.
So Mark, you've been following the financial press for your clients. Have you seen some companies in the news recently, or is there more to say about this?
Yes, there are companies out there, like for instance, Stanley Works back in 2004. They were a company headquartered in Connecticut, and they were going to go overseas to the Netherlands. And when the Congress got word of that, it was our own Chuck Grassley that came forward and tried to put some legislation together to stop that. And what happened was Stanley thought it would be a public nightmare for their public relations nightmare, and so they decided not to do it.
Is this the kind of question your clients ask about? Was this in the headlines enough to trigger an interest among the people you talk to?
I don't get a lot of questions like that.
Okay.
But we had something happen recently. Walgreens, if you all know, just recently decided that they thought they might like to go over to Switzerland. And that was a big uproar. They thought they could save like $80 million in taxes per year. And so this was a big windfall for them, they thought. And once the government got a hold of that, I think they brought their CEO and their management team in, and the government talked to them. And finally, Walgreens caved. And but they were going to do that. And so a little investment tip that happened was on August 5th, Walgreens stock was selling for $69 a share. The day they announced that they were going to not pursue going over to Switzerland, the stock dropped $10 that day. That's a 15% drop. And so what a buying opportunity that was for an investor if they were watching the market that day.
So Veronica, who are the players in the political scene? We heard some from candidates during this recently concluded election season, and then people in public office talking about this.
Yeah, so President Obama in July called companies that engage in corporate inversions corporate deserters. That's a loaded term. Elizabeth Warren recently has been in the news for opposing an Obama pick. Antonio Weiss was picked by Obama to be the Undersecretary for Domestic Finance in the Treasury. He also, before his pick by him being picked by Obama, was working for an investment bank that advised Burger King to purchase Tim Hortons and invert or engage in the corporate inversion. Senator Levin and Representative Levin, their brothers, have also proposed legislation to make it more difficult for companies to engage in the practice. So, as not surprisingly, as it's been in the media more, it also has gained some political traction.
So I think this topic might sometimes confuse people who've heard of other ways that companies might move part of their business overseas. Is there some confusion there that we have to help our listeners with? Are there other ways that companies are taking their business offshore and being charged with this desertion or disloyalty?
I can answer that. My background with manufacturing is that a lot of times materials, parts, are the #1 cost in producing a product, and #2 is labor. So a lot of times a company will, if they're using a repeatable part like glass on a PC or glass on a cell phone or something, they may decide to have that made somewhere else. So they'll actually build a building, move it overseas, or maybe PCB boards, they'll build those overseas. And then sometimes they'll actually have finished goods built overseas, like Amana Refrigeration. They might build microwaves and refrigerators in Mexico rather than building them here, then ship the finished goods back over to the U.S. So, yeah, there's some good reasons for moving your business overseas, or parts of your business.
Yeah. And I'm looking for some history here.
Yes,
too.
well,
Yeah.
so the other thing that goes on, multinational corporations doing business in different parts of the world, that's a very common thing. More related to the tax aspects of it is that companies find creative ways to transfer profits from the U.S. over to a foreign country. And while, and I'm not a tax expert, but while the American tax law taxes corporations on their income no matter where it's earned, until the profits come back to the U.S., they don't pay taxes on them. And so there are creative ways to attribute costs, to say more of the costs happened here or more of the revenue happened there. This is basically creative accounting, and to move the product. It doesn't change how the business works, where the product is produced or who consumes it, but where the profits show up, whether they're earned in Ireland or whether they're earned in the United States, for the purposes of tax law. That's been going on for a while as well.
So let me clarify one point there. Is it the case then that a company could engage in this practice of corporate inversion without Americans losing jobs? This doesn't necessarily mean people moving overseas or plants moving overseas.
That's right.
Is that
What
correct?
Mark was talking about, I think, is a lot more what we would call outsourcing, right?
Right.
Which is where the work actually gets done. When a company inverts, typically the work is still being done in the United States. The Walgreens would still be here in the United States. It's just that Walgreens would be technically a Swiss company. By the way, I love that example because somebody suggested that the corner of Happy and Healthy was somewhere in Zurich. But it wouldn't really change where the business was done, where the jobs were where the products came from and how they flowed. It just changed the accounting of where the profits, whose law applied for taxing the profits, and this is really a tax avoidance scheme.
Okay, so what are some of the justifications, Veronica, that companies are making? They're complaining about American tax law. What are some of the other complaints that they're making in addition to what John told us?
Well, I mean, I think that's the largest point. Yeah. I also think that corporate inversions are just a sort of ad hoc self-help way to create tax reform while Congress does nothing. So in the absence of a comprehensive corporate tax reform, it's just one of the many strategies that companies are using to lower their taxes.
Okay. Does anybody know any of the history here? Is this a new problem? Is this a problem that's been with us for a long time?
I don't know if it's been around a long time, but you know, it might not be a big problem as far as dollars. They say that there's about $2 billion that we could lose, and corporate taxes generate about $333 billion, so that's not a big number, but $2 billion, yet still is a big number that it should get some attention.
For the others, do you think this is do you think this problem is big on a national scale, or it's important because it could grow big? Is it important now, or is it symbolic?
I think it's more of the latter. I think that it's a little surprising that companies have lots of accountants thinking up interesting ways to avoid taxes, which is legal, as opposed to evade taxes, which is a crime. And it's a little surprising that they haven't thought this one up sooner. I mean, you have to recognize that American companies merge with foreign companies all the time. What makes tax inversion dodgy is the fact that what you really have is the tiny foreign subsidiary wagging the large American dog, right? So take Anheuser-Busch, which makes, you know, that most American of beers, Budweiser, but that's actually a Belgian company now, right? It's owned by InBev, which is a Belgian company, and nobody's particularly upset about that. InBev is a very big company, and Anheuser-Busch is now a piece of it. But the inversion thing is, you know, you acquire a little tiny company, and then you say, that's the boss, and this great big American company, we're just a little division. We're just a division of that little tiny Swiss company or Irish company or German company or whatever, Dutch company or whatever.
I'm not familiar with a lot of regulations on inversions before 2004, but I do know that in 2004, Congress passed legislation requiring, if you wanted to invert, the company that you purchased had to own 20%.
That's right.
And so, you know, since 2000, so in 2004, it became a little bit more difficult. The legislation that Senator and Representative Levin have on the table right now proposes that the company you purchase must own at least 50% of you know, the new combined company, which would slow the process of inversions quite dramatically today, but might not make a huge difference in the long run.
So is that a principal means of trying to check this practice, Veronica? What are there other steps that Congress or the Department of Treasury or the President are thinking about here?
That is the reform that I've seen gain most traction, and so absent of, like I said before, a large-scale corporate tax reform, this is the most popular piecemeal way of preventing the practice.
And I'm going to stay with you for a moment here and ask you a little bit more about what you thought the significance of this was in the recently concluded political campaigns.
I don't think that corporate inversions were a large issue this time around. I do think that it's not politically advantageous to necessarily come out in favor of corporate inversions, you know, and that's for both Republicans and Democrats. And then I do think that you see more Democrats, but not exclusively Democrats, coming out against the process.
So I saw this when I preparing for this show. I went to the index or the search window on the Wall Street Journal, and there's an article every week throughout the fall on this topic. It was easy to gather a couple of dozen articles very, very quickly. Do you have any sense that was this a big issue for us this year?
I don't know if it was a big issue, but you know, companies are always looking for a competitive advantage. So if you can lower your taxes by going overseas, and then the poor company like Stanley that stayed where its two competitors went overseas, now the playing field is not level any longer. You know, let's say Walgreens would have been successful and gone and headquartered in Switzerland. What would that have done to CVS? I mean, CVS would have a huge unfair playing field. So, you know, we may see more of these because of that competitive edge. Companies are always looking for shareholder value.
So Mark, we're all employees. We're all trying to save for our retirement, so we're all investors, even if we're not used to applying that word to ourselves. We're citizens of the country. We want to see the government pay its bills and deliver the services it's promised. Maybe sometimes so there's a conflict there that we want to see these companies prosper, and then in another role we might object to this practice.
Well, the world's a whole lot bigger than just the United States. I mean, the middle classes are growing all over the world, and you really need to be investing internationally. Companies need to be investing internationally. You know, if you're a company in America and you're just selling to Americans, you know, you could be a good company, but if you can sell your product to the USA and to all countries around the world, you'll be a great company. So we shouldn't be amiss, or, you know, we shouldn't, I don't know, I don't believe there should be a big conflict there.
Okay.
We should definitely be investing internationally, whether you're investing in your IRA or whether you're a company.
So I want to touch the others with this too. I wonder if people are applying the same standard when they think of big corporations and they think of themselves. So I think of myself saving for my retirement. I want to invest where I'm going to get a good return, right? And as a consumer, I want to save. And so if I purchase a global fund, am I a traitor to the United States? Is there a difference here? Are we applying a different ethical standard to the corporation than we are to ourselves?
I think that's not really quite the right example.
Okay.
And the point is that if I invest, and I guess at some level I do, in my retirement accounts, I invest in stocks from foreign countries. But when I earn that income, I pay U.S. taxes on it. I don't get to pay Korean taxes or whatever. I'm not even sure what companies they're investing in. It's a mutual fund of some sort. The better example that I could come up with is, so Sweden has a very high top marginal tax rate. Most of the Scandinavian countries do. And at one point, Bjorn Borg, who was the great tennis champion from Sweden, decided that he just didn't like paying the taxes, and he stopped being a Swede and moved to Monaco and said, I'm now a Monacan, I guess, a citizen of Monaco, and Monaco has much lower personal income taxes. And I think if I were a Swede, I would feel pretty bad about that, right? This was our great hero, and now he's decided he doesn't care as much about being a Swede as he does about paying lower income taxes. We had a similar thing with one of the famous golfers who said, I'm going to move from California to some other state. It's the same sort of thing. So I think that's the real. There really is something about saying I'm no longer an American company. I'm now a Swiss company, or I'm now an Irish company or a Dutch company, and to me the thing about inversions is that you are able to do this so easily. Just a little tiny piece. This is why I say the tail wagging the dog. The tail can be Swiss, and all of a sudden the whole dog is Swiss. Right.
Yeah, I would agree with that sentiment. I mean, an ordinary American can't change their address in order to pay a lower tax rate. You know, so I think issues of equity and fairness definitely come into play when we're talking about corporate inversions. I can't move my wallet from one purse to another purse and pay a lower tax rate as a result. And you know, comparing corporations to human beings, not to open Pandora's box, but, you know, I think the reason why there's a certain degree of outrage when it comes to corporate inversions is that, you know, as a human being, when I pay into, you know, when I contribute to tax revenues, I also get an educational system, you know, various social welfare programs. And the same is true for corporations. When they pay into, you know, contribute to tax revenues, they're also taking advantage of United States research and development dollars, intellectual property rights, our infrastructure system. And so that's why people are outraged, I think, that they would be paying a lower tax rate because they also benefit from being in the United States, and therefore they should contribute to the infrastructure that the United States provides them.
They're still paying taxes on that part of the infrastructure that's in the United States, are they not? Are they not still paying local taxes, paying for roads, they're paying for schools, they're paying for the income they earn in the United States. Is that not true? So the argument, I think, is that corporations in the United States are taxed wherever they do business, or there's
They're actually taxed on their income worldwide.
right.
But
So
again, I think Veronica's onto something. So property owners pay for schools through the property tax. Corporations pay some they pay some property taxes too, I'm sure, but that's not the largest source.
Okay.
That's not a big part of what they pay for.
Okay.
The corporate income tax is a mechanism for taxing people who earn their income through corporate sources, because while at the end of the day, Mitt Romney aside, saying that corporations are people too, at the end of the day, people pay taxes. Only people can make sacrifices, and so people pay taxes. But income that comes, people who get their income in different ways can pay more or less taxes, and being able to earn your income through something called a corporation, or certain types of corporations, the big types of corporations,
Okay.
that income is taxed at a preferable rate, and this gives so without the corporate income tax, if we didn't have the corporate income tax, we would need some way to attribute that income back to people, or they would find ways not to pay taxes on it at all.
So we've got a kind of arcane issue here, Mark, and you're sitting up here with 3 professors, and you're talking to people who just want to know how to make the IRA grow a little bit faster. What do you advise them when they see a headline about an issue like this in the news and they want to understand something like this? Where can they go to find trustworthy and accurate information?
You know, I tell them to seek out your financial advisor and buy good quality investments. You know, if a company turns out to be, a corporate inverter, you buy and hold your stock. You know, if it does go down in value, it'll come right back. But if you just buy quality investments and hold them for the long term, you'll be just fine.
I think it's a trick question because, yes, going back to your initial observation, I think it depends on what hat you're wearing. So as an investor, you may be looking for, sources of information that are different from if you're a voter, and which are different from sources of information you may be looking for if you're writing a college report, right? So, it's a good question, but it really depends on what hat you're wearing.
Unless you're a day trader, you don't want to be reacting to these short-term things. You want to think long-term.
Okay. Have efforts to, this is mainly a political science question, but I want to hear from anyone who has an opinion here. Have efforts to regulate this produced unintended consequences? And are we likely to fix one problem, fix one hole in the dam and see a leak spring out somewhere else as we try to
Yeah,
deal
so
with
a
this?
lot of commentators have sort of called this what I would call piecemeal attempt at regulating corporations whack-a-mole because, as you said, corporations are paying a lot of money for sophisticated advice and lobbying that helps them avoid taxes. So I do think that short-term solutions are exactly how you describe them to be, and that comprehensive corporate tax reform is really what people are looking for in the long term. Is that going to happen, though? I don't think tomorrow.
And if it does happen, you have to ask yourself who is going to shape the nature of that tax reform, right? So that while we may think that, by the way, just so we're all on the same page, this is perfectly legal as long as you meet the 20% rule that Veronica mentioned. The companies are not doing anything illegal by doing this, and as the IRS actually favors people being able to avoid taxes to the extent that it's legal. But we do have to worry a little bit about whose ear is going to be bent in Congress by whom, and when the time comes to reform the tax system, to who's going to be shaping the nature of that tax reform.
That's right.
Definitely.
There's been some comment in the news about how the law is being made. Is this a law being made by Congress? Is this administrative law? The president once again said, if Congress won't act, I will, and so on. So do you have any comments about the method by which public authorities might regulate this practice?
I mean, it's entirely possible that President Obama can take executive action in some form or another to prevent the practice of corporate inversions. And in fact, Jack Lew, his own Treasury Secretary, has asked President Obama to look into the issue and prevent the practice as far as he can. But again, not to keep going back to comprehensive corporate tax reform, but the only way that there will be a long-term solution will be through Congress. So anything the executive can do would be short-term on an ad hoc basis.
All righty, we're nearing the end of our allotted time, so we'll look for one or two more questions and give each of you a chance to make some final comments if you like. If you think about what an ideal tax law would be, and that might be too much, but is it possible to have a law that's simple enough to comply, and that, you know, Mark, when I look for sources of financial advice, I'm struck sometimes that I open up the book or the radio program and the television program, and the first thing is about how to avoid taxes. So no matter what I'm planning for in my life, to have a child, to buy a house, to go to college, to buy my health care, the first thing is about how to deal with taxes. So taxes have this effect of inducing some kinds of behaviors, and they also raise revenues, and we want to strike a balance there. Do you want to make any comments about the difficulty of that task?
I think one can picture, and economists do this all the time, picture what an ideal system would look like. It is a complicated system, precisely because the income comes in different forms. It flows through different channels, and people have a great incentive, particularly people who manage large amounts of money, whether it's corporate or otherwise, have a great incentive to find ways to minimize that. And so I think it'd be a very difficult thing to do well. It's going to be a political game, not an economically efficiently designed system, and that's going to be a messy thing.
Yeah, I would just add that, I read somewhere that it might be too much to ask corporations to be patriotic, but it's not too much to ask Americans, American investors and American citizens to pay taxes. And so, one of the options that's floating out there is to tax capital gains at the same rate as we tax our income, and that way corporate tax isn't an issue anymore. It's the investors that are paying that.
You have a final word, Mark?
One of the biggest concerns investors have is saving money on taxes, and so this certainly goes along that subject.
Okay. Well, I thank you all, John and Veronica and Mark, for an informative and engaging discussion, and I thank the audience for joining us today. Thank you.